Every second, the United Kingdom adds more than £4,900 to its national debt. Every minute, that figure climbs by £294,000, which is more than £17 million per hour. The UK now owes £2.9 trillion, a record high in the country's history, representing nearly 96% of the nation's entire economy, a debt that surpasses the economic output of Australia, Russia, or South Korea. Britain finds itself entangled in a complex network of domestic liabilities and foreign obligations. But why did the UK borrow this amount of money? Public debt has long been part of Britain's economic architecture, historically used to finance wars and infrastructure. However, the path that worries policymakers today began after the 2008 global financial crisis, when the UK's debt jumped dramatically from 36% of GDP pre-crisis to nearly 65% by 2010. Throughout the 2010s, slow economic growth, averaging 1.5% per year, coupled with austerity measures, constrained the government's ability to reduce borrowing. As a result, interest payments were consuming nearly 6% of annual public spending, leaving less room for investment in social services. During the pandemic, the government borrowed an additional £400 billion between 2020 and 2022, pushing national debt beyond 100% of GDP for the first time since the early 1960s. The UK's current debt crisis is therefore not sudden. It is the outcome of multiple economic and geopolitical forces converging simultaneously, placing unprecedented strain on the nation's public finances. First, productivity growth has stalled, averaging just 1% annually for more than a decade, half the pre-2008 rate of 2%. This persistent stagnation directly weakens the nation's ability to generate revenue. Even a 1% shortfall in GDP growth can deprive the Treasury of £20 to £25 billion each year, widening deficits and forcing the government to rely more heavily on borrowing. Second, rising interest rates have dramatically increased the cost of servicing debt. The Bank of England raised rates from 0.1% in 2021 to 4% by 2025. With total debt standing at £2.9 trillion, every 1% increase in interest rates adds an estimated £12 billion in annual interest payments. This surge has made the UK's debt servicing burden one of the fastest growing in its modern history. Third, a persistence of large structural budget deficits. Over the last 5 years, the UK has run deficits generally of around 4.8 to 5.3% of GDP annually. The NHS alone accounts for around 20% of all government expenditure, pensions and welfare consume 30%, and education, defence and transport collectively absorb another 21%. Finally, geopolitical and trade frictions have reshaped the economic landscape. In the aftermath of Brexit, UK exports to the European Union, its largest trading partner, fell by almost 12% in the first years. Additionally, increased tariff barriers, logistical delays, and reduced labour mobility have all contributed to slower economic growth, weaker tax revenues, and ultimately higher levels of borrowing. Taken together, these forces have created a fiscal environment in which public debt grows faster than the economy, interest payments rise faster than revenue, and the pressures on government spending intensify year after year. But who actually owns Britain's debt? The UK government raises money by issuing gilts, government bonds that are purchased by a wide range of investors. These holders fall broadly into two groups, domestic and foreign. The majority of Britain's debt, roughly around 55%, is held by domestic investors. These include the pillars of the UK's financial system, pension funds, insurance companies, major banks, and private investors. Their demand for gilts reflects the stability and reliability historically associated with UK government bonds. A significant portion of domestic ownership also comes from the Bank of England, which holds nearly 25% of all outstanding gilts, valued at around £725 billion. This is largely the result of quantitative easing programs introduced after the 2008 financial crisis and expanded again during the pandemic, when the government needed emergency financial support to stabilise the economy. Beyond the UK's borders, foreign investors hold around 45% of the nation's debt. These international creditors include some of the world's largest economies. Japan accounts for roughly 6%, the United States holds around 5%, and Eurozone countries collectively own close to 20%. China's share is smaller, at approximately 2%, This global distribution of debt holdings is both a strength and a vulnerability. On one hand, diversified international investment signals strong global confidence in the UK's financial system. On the other, it exposes Britain to currency fluctuations and external economic pressures beyond its direct control. But somehow or other, the UK's rising debt burden carries profound risks: economic, strategic, and geopolitical. Meanwhile, the British pound has fallen nearly 15% against the US dollar since 2021, further increasing import prices and raising the real cost of foreign-held debt obligations. Additionally, a significant share of debt is held by foreign governments and international institutions, giving them subtle influence over UK policy and shaping decisions in ways that may not always align with Britain's strategic interests. This fusion of economics and geopolitics is one of the most overlooked risks of the UK's current debt environment. Rising borrowing is not only a financial challenge, it is a question of national resilience, autonomy, and long-term stability. To manage a £2.9 trillion debt, the UK must pursue coordinated economic and fiscal strategies. For example, raising economic growth from 1.5% to 2.5% could potentially generate an additional £50 to £60 billion in revenue annually, without increasing taxes, assuming the tax to GDP ratio remains constant. Second, reducing the deficit from 5% to 3% of GDP could help stabilise the debt to GDP ratio as the population ages. Finally, extending gilt maturities, issuing more green and infrastructure bonds, and refinancing short-term liabilities could save billions in future interest payments. With a debt burden now exceeding £2.9 trillion, the country faces rising interest payments, vulnerability to global markets, and the strategic influence of foreign creditors. But with the right mix of policy, growth, and stability, Britain can navigate its way through this crisis. However, the UK's debt trajectory appears likely to extend far beyond its shores, unless the government takes the necessary action.